and welcome back to another exciting edition of Rate Desk. I'm your host, Michael Thomas, here to talk about multifamily interest rates and other news. First, going to the markets today. Dow Jones Industrial was down in the afternoon session, and the NASDAQ and the S&P were both up. There's been some positive news on the Fed reporting, both consumer spending remained positive, and we have seen some slight growth, I guess, in wages in most districts, and we've seen some job growth, employment growth in almost all of the districts. So some positive news there. Going over to the 10-year Treasury, that is up 9 basis points from where we were last week, trading at about the 80 to 81 range. So that's a pretty significant difference there. The Fed commented, that they don't see rates going up through 2022. They're talking about, of course, the short-term rate, which is what Fed controls. They do not control the long-term interest rate. That long-term interest rate is much more affected by moves in treasuries. So interesting to note, one analyst today said, when will we see this 10-year treasury yield really go spike up, back to 1% and above? And his prediction was 5 minutes after there's a vaccine. So even though we are probably in a low interest rate environment on the short-term side for an extended period of time, I just like to remind folks that the long-term mortgage market does not necessarily follow that. So you really got to keep an eye on that 10-year treasury yield. And that's a pretty significant move. So just want to point that out. Over on the crude oil side, we're seeing them range bound to last week, about $40 a barrel, still in that same range. And the good news is rates on FHA didn't really go up much. They did tick up a little bit, I think, with the move in the Treasury. So the 223F is quoting this week at 226. That is 2.26. And the 221D4 quoting at 2.86, still incredibly low interest rates in this market. Again, that is the mid-range. Jumping over to agency desk, best case scenario, a little tighter than we were last week in our quotes, 275 on the Fannie Mae. That is a 10-year fixed rate. And over on the Freddie Mac, we're looking at about 3% on the low end of the scale. Again, subject to if it's affordable or not. And of course, there's some incentives for green that could get you under that 3 handle on Freddie Mac. So keep that in mind. Now, jumping over to other news, a couple of things I want to speak with you about today about affordable housing updates. One in particular, the low-income housing tax credit, that is the non-competitive credit, is the 4%. It's non-competitive because a developer who wants to build affordable housing units can go to their state authority and basically request these funds in the form of a private activity bond. There's a couple headwinds that have been occurring that I just want to make you aware of, and a solution. So the headwinds are states are running out of this private activity bond amount. So they don't have enough of these funds to go around to the demand for affordable housing units. So that's one problem. Another problem is in the COVID era, we've seen a decrease in the price that investors are willing to pay for these credits. That shrinks the amount of equity a developer can receive on a project. And third is the applicable federal rate, the AFR, is what the 4% credit is set to. Okay, so you think the 4% credit is 4%? No, of course not. That'd be too easy. The 4% credit today in October is 3.07. Now, there are advocates and there's definitely bills that have been presented to get signed and to fix this 4% credit at the actual 4%, which would unleash a lot of dollars, of course, to build more affordable housing. However, that is not going to pass anytime soon. And so as a result of these combining factors, we're seeing a crunch in terms of the capital available to build affordable housing units, more than usual, right? We typically, there always is a crunch, but now with the private activity bonds being limited and both the applicable federal rate being at a historical low and investors paying less, you're really seeing it much more difficult to get these deals to pencil. Long way to get to the solution here with the HUD FHA 221D4. I just want to bring it up. Look, I know I sound like, I'm a hammer, and if you're a hammer, everything looks like a nail. But this truly is a solution in affordable housing development. I'll tell you why. Because of the low interest rate environment that we're in, the 221D4, call it in that 280 range, even with an MIP of 35 basis points or 25 if it's a Section 8 property, you're looking at a low 3% fixed rate, you've got a 40-year amortization that drives your loan constant down very considerably, and it frees up capital. I've seen anywhere between 20 to 30% more in capital available for a deal. Guess what that does to your sources and uses? You do not need those soft funds. And a lot of these state authorities are now saying to developers, look, we don't want you to rely on these programs. We don't have enough to go around. So the more money you can bring in here and shrink your own gap, the happier we're going to be in awarding you these credits. So that is a workaround. Now, one last technical element. Sorry, this is kind of a technical episode today, but one last technical element is that, as you know, if you're a developer, you have to use tax-exempt bond proceeds if you're doing a 4% affordable housing development. Okay, you can't get that unless, if you're using a HUD loan, unless you use a short-term tax-exempt structure. The good news on that is this short-term tax-exempt structure, think of it just like a blanket. It's just like a layer and it goes away, it pulls off after construction. The cost of it is pretty minimal. You know, there was a time doing these bond transactions when this number that we call this negative arbitrage number was above 10%. Now, you know, for the entire period of construction to add this tax-exempt layer that you need to use the 221d4, it's probably going to cost you, you know, maybe 50 basis points, and it could be lower than that. So it's not too bad, not too much of a hit. And certainly, if you're getting $2 to $4 million more and it eliminates your financing gap, well, now you've got a deal that pencils and more affordable housing units are going to get built. So talk to someone that's experienced like me about that and knows how to add that layer in, and there are others out there that do, but that is a great workaround to keep building affordable housing while we are feeling the pinch here. Now, quickly, I want to jump over to market rate side. Had a conversation today with a client looking at active deals, going to conferences and hearing what the numbers are like. So one thing, you know, if you're looking out there for an 8% cash on cash yield, which a lot of investors is kind of a sweet spot there to look for, it's challenging in this environment. Why? Properties right now are trading, even in smaller secondary markets, maybe even some tertiary markets, around a 4 to 4.5 cap rate. That is pretty low, and it's difficult when you're trying to negotiate your exit, whether it's a value add play or, you know, a core plus type of thing. If you're buying at such a low cap, it really is hard to predict that you're going to get it even lower at takeout. Of course, you could be relying on rent bumps. That might be a little harder to pull off currently depending on the market. So those are my updates for the week. Thank you all so much for tuning in, and don't forget to watch a very exciting upcoming episode of Money Talks. We'll be having a gentleman, investment banker from UMB, is going to be talking about negative interest rates and all kinds of interesting things going on in the market. Make sure you come back to Yield Pro TV and check out that episode. Thanks again for tuning in. I'm your host, Michael Thomas, signing off.